Okay, for this video, I want to go over a common question I get, which is what exactly is a disregarded entity? So I've got one slide in front of us here with the rules, and what we're going to do is also look at an example for a single member LLC that's a disregarded entity. And I also have with us a Form W-9 that's completed for that example. So if I go back to the slide here, we'll just cover some of the default rules and then get into what exactly is a DRE or a disregarded entity. So the first step that we always take is we look to whether an entity is by default a corporation, right? So in the Treasury regs, we have certain default classification rules for all types of business entities. And the starting point is always whether or not an entity is a corporation first. And the reason for that is under federal tax rules, when you have domestic or foreign entities, a lot of times, it has to be treated as a corporate entity for federal tax purposes. And so you can't have a disregarded entity or you can't change its election. So the first point is always if the business entity is classified as a corp, then it's got to be a corp for federal tax purposes, absent some unique exceptions where you might be able to make an S corp. So how do you know you have a corp? Well, if you form a corporation under state law, and so the document that you would be filing is the Articles of Incorporation. And so that's typically a good indication that you've created a corporation for state tax purposes. So for example, you might form a Delaware Inc. So that's a Delaware corporation. Florida, we have Incs as well, just regular for-profit corps. But we also have Florida PAs, which are professional associations. Those are treated as corporations for tax purposes. And we also have PCs as well, so professional corporations, also treated as C Corps for tax purposes, unless you want to elect to be taxed as an S Corp if it's available. Okay, so that's, again, the starting point here. Now, if the business entity is not required to be classified as a corp, then it's going to be considered a domestic eligible entity. And so that standard is found in Treasury Reg 301-7701-2B. So what are the domestic eligible entity default rules? So there's two standards, right? If you have a domestic eligible entity, it's going to be a partnership if it has two or more members, and if the domestic eligible entity has one owner, then it's going to be a disregarded entity. So for the partnership, we look at the example here. This is a very common fact pattern. We have John and Sam form a Delaware LLC. Each person owns 50%. Under the default rules, this LLC is a domestic eligible entity with two members, so it's going to be a partnership for federal tax purposes. Okay. Now, the disregarded entity example, we have Jack here, forms a Wyoming LLC and he owns 100%. Now, under the default rules, in this Treasury Reg section here, the LLC is a domestic eligible entity, right? So it's not a corp, and it has a single owner, so it's going to be treated as a disregarded entity for federal tax purposes. Okay, now when we talk about this note here, very, very important, when we talk about regarded versus disregarded entities, if you have a regarded entity, it does not necessarily mean that the entity is going to be subject to tax directly. Okay, so for example, the partnership LLCs are regarded, right, because it's not a single member disregarded entity. So it is a regarded entity in that it's treated separately for tax purposes. It has to file its own tax return, but just because that it is a regarded entity and files its own tax return does not mean the entity itself is subject to tax, right? The partners in a partnership are liable for taxes. And the same principle applies for an S Corp. If you have an S Corporation that's a pass-through entity, even if it has one owner, it's a regarded entity for tax purposes because it's an S Corp, even though it's pass-through, and then the shareholder or shareholders, if you have multiple shareholders, are going to be the ones subject to tax on the income. So the disregarded entity, it still legally exists under state law, right? So the LLC can open bank accounts, conducts business, hires employees. It can do all these other things that you would maybe think a corporation can do. But when we talk about its tax treatment for federal tax purposes, it's disregarded in that all of the income, all of the expenses, it's just going to be reported directly on the beneficial owner's income tax return. So in our example here, we have Jack forms his Wyoming LLC as the sole owner. The LLC is going to be a disregarded entity, so Jack isn't making an election to treat it as a C Corp or an S Corp. So the LLC, when it goes to open a bank account, let's say, and it has to prepare a W-9, it's going to use Jack's information as the owner because it's a disregarded entity. So if this LLC, for example, is in the business of selling marketing services and it generates, gross income and expenses, all of this activity is going to be reported on Jack's personal tax return, a Schedule C, rather than the entity itself filing its own federal tax return. So the W-9, if we look at that really quickly here, so this would be if Jack is going to go open a bank account for his LLC, right? So we have Jack's Consulting LLC is entered as the business name, and it's also the disregarded entity name, right? Because remember, everything is going to be reported on Jack's individual tax return. So the bank or any other customer that's making a payment to you, let's say, they're going to need Jack's information as the beneficial owner. So when Jack completes the W-9, he uses his name as the beneficial owner of the income. So that's the name that's going to be on his tax return. He could put the name of his business, right? This is the disregarded entity, Jack's Consulting LLC. And then in box 3, he checks individual, sole proprietor, or single member LLC, right? This is a single member LLC that's a disregarded entity, okay? Now, he enters the address down here, and then in part 1 for the taxpayer ID number, he would use his social security number, okay? So you do not use the EIN of the disregarded entity. You use the tax ID number of whoever is being reported on line 1. In this case, Jack is the beneficial owner. He's the individual here that is the owner of that single member LLC. So his name is on line 1, and then his tax ID number is reported here in part 1. And then Jack just simply signs the part 2 certification, dates it, and then he provides this to whoever requested it, right? Whether it's the bank, a customer, if he opens a brokerage account, whoever needs this. So I hope that was helpful and clarified some of the issues around what is a DRE. If you have any questions, please leave me a comment below, and I look forward to seeing you again soon. Thank you.